Oh my goodness. I got myself a fresh Saradomin brew here because boom, I hope you're celebrating today, but we have 3 important things to talk about. Number 1, I was wrong and I could be wrong again, and I want to show you something. Number 2, the Fed responded to today's CPI print already, and you got to know about that. Then I want to show you some stocks and trades that you potentially want to pay attention to, which we'll go through towards the end of the video. Let's get right into it. So look, first in January when the NASDAQ was at like 353, I said the market probably had 20% more downside. But I made a mistake. I looked at the technicals too heavily and saw a quadruple bounce at about 318 on the NASDAQ and thought, wait a minute, no wage price spiral, which is still true today, and we might be getting that peak inflation in March. We did have that decline that later came in April, and we thought, hey, maybe that was a sign of the bottom. And we had a beautiful bear market rally, which really just led to some unfortunate additional downside. Now, the reason I'm saying that I was wrong in identifying the bottom, I identified it too early, 318 was the QQQ bottom that I thought. I kept maybe 20% of my cash aside, but I went in pretty dang close to 318. The truth is, I could be wrong again. And so I want to be held accountable for that and just be honest with you that I can be perfect with this, okay? Now, the good news, though, is we are now using that 318 level as support. We're sitting at 325 now, and today's CPI number was going to be what either created that 318 as support or resistance again. And clearly with the CPI print, the way it came in this morning, is such a beautiful miss. All of the expectations and the qualified economists were wrong again, and inflation comes in outside of expectations, but fortunately to the low side, we have something beautiful. An inflection point. And I have to caution you though, because this has happened before and this chart might make you sad. Now, on one side, you've got a lot of individuals saying, hey, wait, well, like, this is awesome. That's it, we've hit peak inflation, we're done. No more inflationary concerns, we are going back to the moon. And I really hope that is to be true, but hopium is not an investment strategy. And this is where we have to be honest with ourselves that we've hit peak inflation previously. And that's why this chart here is a little bit disappointing and actually gives credence to a lot of the people who say, wait a minute, real inflation, first of all, is way higher than this report. And that's probably true. But even if we get an inflection in, the CPI inflation, at least it gives us a softer Fed and probably means that even if real inflation is twice as high, even that might be peaking, right? But the sad thing about this particular chart here, folks, is right here, is that we have seen this sort of peak before. See that green dot there? We have been down this road before. That was March, and then we got a decline in April, and then we went higher than March. And then we went even higher the next few months. And so that's why we have to be real here and recognize that, just because we got that March peak over there, and now we've got ourselves another peak over here, which represents June. Now we just got the July numbers, which are thankfully lower over here, doesn't mean that we can't go higher. Now, one thing that is very different though from that March peak is that the March peak coincided with break-even expectations for inflation way high. In fact, take a look at this. See here, these are the March break-even inflation expectations. That's just a fancy way of saying, what does the market think inflation is going to do? And what's so important about this is that this line tends to move 3 months before CPI moves. And that's really important because if we did hit a peak here in March, this was a warning that the actual peak wouldn't really come until 3 months later, which ended up taking 4 months, came in July, right? 4 months. So anyway, that's really fascinating. And this decline, which I'm gonna move myself here for a moment, this decline is ahead of us, which is really, really exciting that decline in break-evens is ahead of us. And it is a reason to be optimistic, even though 8.5% inflation is still pretty dang high. In fact, take a look at this. This was a reply tweet, and I want to give a shout out to it because it was kind of funny. This reminds me of you. I love you, bro. I love you too, man. March inflation is 8.5%. No! Terrible. And then, of course, August inflation is 8.5%. Let's go. We're going back to the moon. Like, yeah, it kind of is, because the reality is, the answer here, the logic here is that this is the uptrend, and then now we're on the potential beginning of the downtrend. But again, I've told you I've been wrong, and I could be wrong again. Now, I do believe, maybe I'm biased, I probably am, because I'm talking about myself here, I think I've been a lot more right than I've been wrong. For example, I literally to the day timed the bottom of the dollar, shorting the dollar. In fact, here on screen is a post that I posted when the dollar was at the bottom, talking about how I want to get into what I was calling the great dollar short, and how I'm shorting the dollar with options to leverage that a little bit, but not margin, because I hate margin, but that I expect a substantial retracement to the upside in a dollar short position, which would mean the dollar falls, right? This chart you see here is an inverse, right? So as it's going down, the dollar is actually going up. But I am investing expecting the dollar to go down, and therefore this chart to go up. But anyway, there are so many things about our macroeconomy that say right now, this could actually be it. This could be peak inflation. And we could be wrong. Like I said, been wrong before, but we've got energy and commodity prices coming down, and it does look like we are seeing a broadening decline of inflation. This is great. Now, the Fed has responded to this. And I think this is important to look at as well in terms of what kind of response we've already gotten, because it's going to set up more of the responses this market is going to experience from Fed speak over the next month. Because keep in mind, we now have basically a month of freedom to go play in the stock market without having to worry about a stupid inflationary overhang again. And so what the Fed says over the next month will matter. And so here's what the Federal Reserve told us this morning, right after a quick message from our sponsor, and then we'll get into some important picks that I think are critically lagging the market in stocks. Stay tuned for those. I don't know about you guys, but I think it's a terrible idea to buy multivitamins out of a bunch of shady additives that claim they can solve any problem you have. Hate your job? Take this. Your boss will give you a raise, and his wife will even kiss you. It's all BS. But thanks to today's sponsor, Ritual has a transparent and well-researched solution. An extensively researched multivitamin that helps fill the nutritional gaps in a man's diet. They show you every ingredient, every supplier, and every study that goes into their vegan-friendly multivitamin. And even for those of us who try really hard to eat a balanced diet, there are some nutrients that are just hard to get from food alone. For example, 70% of men don't get enough vitamin E, and up to 97% don't get enough vitamin D. And for you obsessive label readers, a Ritual is a vegan-friendly, non-GMO certified, gluten-free, and formulated without any major allergens. Unlike other subscription-based companies, Ritual is as easy to start as it is to end. It takes about $1 a day to have essential nutrients delivered straight to your door. So go to ritual.com/20kevin or click the link in the description and use code 20kevin for 20% off your first month of Ritual. Again, that's ritual.com/20kevin or use the link down below. Charles Evans, the president of the Chicago Fed, told us that this report is the first positive report we've seen. And he says that, look, we've tightened monetary policy quite a bit, but he does expect that we'll continue to increase rates the rest of the year and into next year in line with the summary of economic projections that the Fed gave us, which is that we should see 3.4% by the end of the year and somewhere around 3.75 to 4% by the end of 2023. This does set up the stage, though, that the Fed might begin to slow down. In fact, Fed Evans goes as far as saying, quote, "I feel like we're in a good place, and we can pivot to being more restrictive if inflation gets out of hand." In other words, as long as we stay on this disinflationary trend, we still have high inflation, don't forget that, it's still a big number, right? But as long as we continue on down this inflection, down this disinflationary trend, the Fed can relax a little bit. And so what's the bond market doing? Which the bond market's been pretty dang good at predicting what the Fed's going to do. The bond market tells us that now we only have a 28% probability of a 75 basis point hike in the September Fed meeting, which is September 21st, relatively still far away, about 5 weeks away. That's down from 52% just a day ago. That means the market has really softened its impression of the Fed continuing to spank us around. And even though Fed Evans says we continue to see supply chain challenges, and in hindsight we should have raised rates 6 months earlier, he actually expects the second half of the year to be quite positive, which is a really interesting note coming from the Federal Reserve, that they're not looking at this market as gloomily as they did back in January or really December, when they began to have their Fed flip-flop. In fact, take a look at this on screen here. This right here is a video that I made on January 5th, and I wrote, "The Fed just crashed stocks, the worst report yet." And in this report, when you actually go through the report, you will see, and you could look at the most popular timestamps here, you will see the most horrible phraseology from the Fed yet, with how bad this report was. It's actually a good lesson to go back and watch that video, because it shows you how rough the Fed was and how badly they really had to kick us in the behind to make us realize, oh crap, things are about to be bad. It still took me about 16 days to go, oh man, wait a minute, this is gonna mean something for the portfolio. But holy smokes, when I hear the Fed say, in Fed speak, expect the second half to be quite positive, we're finally getting bullishness from the Fed back. Also, Fed's Kashkari just spoke as I've been recording this video. The current updates are that he believes we are far, far away from declaring victory on inflation, which is of course that, because remember, they have to talk inflation down. That's what they do. They move their mouths to push down inflation, right? And he says that he's happier that inflation is surprised to the downside, but it doesn't change the rate path expectancy for him. He instead believes that we're going to get to 3.9% at the end of this year, 4.4 by the end of next year, which is a lot more hawkish than what the market is currently pricing in, and could set us up for some more downside. This sort of talking the market down, very, very, very common. So be prepared for that kind of stuff to happen in the stock market. He does say it's much more realistic that we're going to raise rates and then leave them there until inflation is on its way to 2%. So this does mean the Fed is going to continue on their path. So don't hold your breath too terribly much that the Fed is ready to U-turn any minute, because they ain't. And the market so far is taking this commentary from Kashkari in stride, as this commentary is occurring right now as we watch QQQ only slightly rotate to the downside off of highs of the days right now. But I want to take this opportunity to talk about some suggestions that I'm seeing in the market. It's very, very popular for us to get frustrated, and I call this the sort of the rising tide fallacy. It's very, very popular for us to get frustrated when we invest in stocks and then we see everybody else's stocks go up. But one thing that happens psychologically is when everybody else's stocks go up, it actually starts yanking on the stocks that are left behind, and eventually those tend to catapult up, which is pretty remarkable. And it's a psychological phenomenon, but it's also one that's based on valuations, right? If a house in a neighborhood is selling for $400,000 and all of a sudden 5 comps sell for 500, well, houses of that model selling for 400 are probably going to start rubber banding up. And by the way, I think if you're not in real estate yet, you have some massive opportunities coming up for investing in real estate. And this is why, as soon as possible, you should get into the real estate investing courses linked down below. If you bundle that with bundle 1 with the stocks and psychology, you get my trade ideas like the Great Dollar Short or positioning, fundamental analysis, which people really, really seem to love some of the fundamental analysis that we're doing. And I'd love to have you in those. Take a look, for example, at just the little post that I wrote this morning, which relates to this idea of sort of the rubber band. Look at this. So Enphase is up 57% year to date, one of my favorite companies, one though that I do believe has some headwinds coming from real estate. You've got Apple down 8% year to date, Microsoft 14, Amazon 17, Google 17, QQQ 19. But look at what's lagging. You've got Tesla still down 29% year to date and Nvidia down 42%. Personally, I believe both of those could end up being rubber band opportunities that once the bad news is out of the way, the Twitter overhang, the glut of chip supply overhang, once that bad news, the gaming overhang, once that bad news goes out of the way, you end up rubber banding to where these others are. The same is true in reverse for something like Enphase, which in my opinion has run too much, is likely to get rubber banded down. It's not in a position that I really want to buy it right now. Though it is very difficult to short in this market, because when you take this sort of basket and the macro economy is driving everything up, even something that fundamentally is overvalued can still go up. And so that is another risk factor. And of course, I encourage you to use the coupon code because, yeah, look, I know the coupon code's expired, but the price goes up over time as we add more value. So you get the best deal when you join early, and any new content for the courses is coming free to those courses. In fact, we've got huge plans for expanding the real estate course to some new topics. That'll be really fun. Updates coming to the property management course, updates coming for more fundamental analysis in the stocks course, which we do every day in the live streams, which I highly encourage you take advantage of. Those live streams on average get somewhere between 4,000 to 7,000 views every day. And there's a reason they do, is because there's really good fundamental analysis in there. And even though I might not trade on every single move, there are a lot of lessons that you could learn from them. So I do also want to shout out that if you haven't yet followed me on Twitter, you could do so and you can get some great responses and commentary like this. See, this morning I wrote, "We're going back to the moon, baby. This is it. I've got my Saradomin brew and we're ready to rock." Of course, the Emperor replied with, "He's going to regret this tweet," to which I replied, "Your mom will." And then, of course, there are responses like this. "The excessive bullishness in terrible macro conditions probably won't work out best. CPI is likely manipulated and real inflation is obviously much higher. The whole rally is a retail trap. At least tell people there's a lot of downside risk." Well, that is what I think I'm doing in this video, is that A, I could be wrong, right? B, I think that there are other downside risks. I'll tell you what the biggest downside risks are right now. The biggest downside risks are the following. A slow decline in CPI, where CPI goes down, but then it like levels off at like 8. And then the Fed's like, okay, I guess we have to hike more to actually get it to go down more, right? So even though CPI could go down, if it goes down too slowly, that's a risk. We could see an earnings recession, and even though Bank of America tells us that even poorer individuals are still spending as much money or are still spending more money now than they did last year, we still have spending growth. We could end up having an earnings recession. However, we could see a tale of two cities event here, where some stocks do poorly and others do very, very well. And that is going to be predicted, or predicated rather, by earnings. But also then we have, like, I think more like edge case scenario dangers, like World War III, right? Taiwan keeps complaining about increasing tensions between China and the worst aggressiveness that we've seen since the 90s. And even Japan is complaining that China is dropping bombs in their exclusive economic zone as training missiles. You know, these are things that increase tensions. But really, I think, if anything, they'd create an opportunity for buying and being in this market. I've bought more the last few days, and really, I'm a big fan of, at these levels, I'm ready to ride and I'm ready to run with you. So that's very important. Now, I did have one other question that came up, and it was a question about QT. My thoughts on what about a QT? Well, so regarding quantitative tightening, something to know about this is, yes, it can restrict the supply of money that is outstanding, which can reduce pressure, buying pressure on stocks. It could also increase selling pressure on stocks, although a lot of institutions are sitting pretty cash heavy right now. So once we confirm a bottom and that that this is not a bear market rally, we would expect more institutional cash to flow in. But QT is really interesting, mostly in my opinion, for keeping the treasury yields high. And high would be like 2.7% on the 10-year or something like that, which does put more downside pressure on the real estate market. So QT, in my opinion, quantitative tightening, is the rolling off of treasury bonds and the selling potentially of mortgage-backed securities. Don't worry if you don't know what any of that means. Basically, QT, in my opinion, is likely to keep treasury yields higher, and I think it has the biggest overhang on real estate, not necessarily the biggest overhang on stocks, which I did spend about 2.5 to 3 hours this morning, again, working on more documents for our attorneys for our Series A that's coming up. Course members will have the first opportunity to invest in the Series A, and if we have any kind of warrants that go along with that first investment, which is like a free call option, which we might end up doing, TBD. This is not a solicitation. This is just sort of teasing what's going on in my life. Then course members will get the biggest share of those, or biggest benefit of those. At least that's the expectation of how we're structuring things now. But folks, we're really, really excited to buy real estate. So you should be buckling up and at least get educated on real estate. Just make sure you stay away from two things, in my opinion. I don't think you directly want to invest in a syndication. Indirectly could be different. You know, if like a company you're investing in does syndication separately, but you get like the promoter fees, I think that's okay. I am not a big fan of REITs because I like investing in companies that can reinvest cash flow and build wealth even more for the company and shareholders. And I do think the worst thing you could do in this environment either way is flipping. So I would really caution against flipping in this market. Look for good deals. Hotter. Maybe even get into short-term rentals, but remember, short-term rentals are a job that take time and work. All right, folks, thank you so much for being here. Appreciate you, love you. Goodbye.